Hello, everybody. I think you can now hear me. I think Sarah and Sam have now unmuted me, which is great. Thank you very much for having me. I just want to say a huge thanks to Sam and the team for inviting me. This is a real treat for me. I'm a big fan of ExpensePlus. And I also really enjoy the opportunity to do some training. And I particularly love the fact that we've got so many people on the Zoom, which I think actually we'd really struggle to do in person, because I can imagine there's all sorts of people from all sorts of areas of the country. Now, I do have a quick warning, or just to make you aware of, this training is I've tried to create some digital interactive content through a website called Aha Slides. So if you want to, I'd encourage you to go use your phone just to go to this website, ahaslides.com/X plus. And what I've got is a number of interactive questions which I'm going to be using throughout the training, which are kind of like polls, multiple choice, which just really helps gauge a feel and also just brings a different element to the training. So if you're happy to go there, that would be great, and you'll see how that works during the training. Hopefully that will be really helpful. If you have any problems with that, feel free to put it on the chat. Sadly, you won't be able to message me directly, but you'll be able to message Sam or Sarah. Now, before I get into the actual training, I just thought I'd give you a little bit of a flavour of who I am. As Sam's already mentioned, I'm a chartered accountant with the Institute of Chartered Accountants England and Wales. I trained as a not-for-profit specialist with one of the large 7 accounting firms called RSM, which some of you may have heard as an audit as an audit senior. Some of the charities and organisations I've worked with that you may have heard about: Christians Against Poverty, British Epilepsy, and Hepworth Wakefield Art Gallery. Those some of the kind of types of largest kinds of organisation which I've had my training background in, which I did for about 5 years before jumping ship and joining my family accountancy firm, really focusing on providing services to charities and not-for-profits and businesses as well that are much smaller than organisations that need an audit threshold. And for me, it's been a really perfect fit because my family practice was set up by my grandfather many moons ago, and we've, for whatever reason, had a heritage of working with charities, churches, and not-for-profits, and it seems to be a specialist that we've developed over the last however many years, working in accounts preparation, examinations, and charity outsourcing. And more importantly, we do it because we love working with charities and churches. It's we do what we do because we're passionate about it in providing the best services we can, but we really love helping churches and charities improve their financial governance, as well as providing kind of a compliance service. Just as a random fact about me, on top of all the kind of accountancy stuff, is I'm a huge fan of apple crumble and custard. So if we ever did end up physically meeting when all this is over and we went out for a meal, apple pie and custard at a really good Yorkshire pub is a massive win for me. So that's just a random little introduction about me. So let's get into the training. As Sam's already mentioned, that we're going to be covering 4 kind of key areas, which I've kind of themed around getting to grips with, which is getting to grips with fund accounting, getting to grips with accruals and cash accounting, getting to grips with accounting for your fixed assets correctly, and getting to grips with what to do at your year end. So they're the kind of 4 areas that we're going to cover. The fund accounting is going to cover the most amount of time. There's a few things to work through there, and the shortest amount of time is what to do at your year end. But I've tried to weight it so that there's kind of covering the key areas. And my hope is there's going to be something in here for everybody, whether you've had many years of experience in working with your church or charity or organisation, or whether you are coming into running your charity's finances with very little experience. So I'm hoping there's something in here for everybody. And something just to look out for, the key take-homes of Tim's top tips is the kind of key message I'm going to put into each section, just so there's an easy take-home, because we're covering quite a lot of content this session. So hopefully this will just make it easier of what the key things are to take. So I've got the first interactive question, which is really just a warm up. So if you go to your phone or if you put it up on your computer, I've got a first interactive question on Aha Slides, which you'll see here, which people have already been giving a thumbs up to say they're on. I think we've got 36 people on already, which is great. So I'll just move on to the first question, which is, how confident do you feel in the following areas? And I've got 4 slides, or kind of from being not having a clue of where to start through to feeling very confident. And the 4 are making year-end adjustments to your accounts, managing the different funds and fund types that your charity has, knowing if I should be following accruals or cash accounting principles, or handling the accounting for assets. So we'll just see what comes up. What's going to come up on screen is basically the average, just to give us a real helpful insight. It's completely anonymous, so there's going to be no names on here, but it's been really interesting just to see how people feel about the different areas, and we'll see what it looks like. So I'll just give a few more seconds just to let them trickle in. So that's great. I think we've got 47 people on, and the votes are flying in. So yeah, we've got a real spectrum there, which is interesting. I was expecting there probably would be a spectrum through to looks like handling assets looks like it's the least, possibly average is the least confident. Knowing if you should be following accruals and cash looks like it's fairly confident. Managing different fund types, that looks like it's really evenly spread across the board. And making year-end adjustments is probably at the more unconfident end of the spectrum. So that's really helpful. Thanks very much. Hopefully everyone that worked all right on everyone's phones and computer. So that's great. So we're going to have a number more questions like that just going through. So well done, everyone. That's working really well. So let's get into it. First one, getting to grips with fund accounting. And the principle of fund accounting is that it applies to all sizes of organization, all charities, whether you are small, large, those who are accounting on cash basis or accruals basis, it applies to everybody. And the key message I will always give to people about helping people remember what really fund accounting is that it's all about managing pots of money and funding. So lots of people will kind of have an idea about this when it comes to working in a business sector, and often it's in a business sector it's usually nice and straightforward. I've got the picture here of a jar of money. In a business you'd usually have one stream of income coming in, one stream of expenditure going out, and essentially you've got one pot of money to manage, and it's usually nice and simple. Now for a charity, it's actually can be a lot more complex. Because as you'll know, and probably in your situation, is that charities can have multiple pots of funding to manage. And charities actually can have many, many, many pots of funding. There's some charities I work with where the screen on ExpensePlus for how many funds you've got just goes off the screen. And some of you are probably smirking knowing, because you probably have that challenge as well. And what makes it more complex with fund accounting is not have you only got multiple pots of funding, you've got multiple pots which have different types, which have different rules, and each fund may have different rules and purposes to go with them. So automatically you're thrown into a situation which is inherently complex. And if you were a business in this situation, it's usually only very large businesses, sometimes PLCs, that have to manage pots of money like this, whereas charities of whatever size have to get good from the word go of managing different pots of money, different funds for different things. And the great thing is, and it's one of the reasons why I'm such a fan of ExpensePlus, is ExpensePlus has many tools, as most of you will know, to help you do this and help you manage it really well. So I've got a second interactive question is, how many different types of fund do you think there are? So I'll just bring that up on screen. Let's see what people think. Great. I think we're getting close to everyone done. We're at 43. Just give it a little bit longer. Definite strong leader for 3 different fund types. It's always interesting, these interactive slides, because some of you might have the tactic of wait until the end to see what the most popular answer is, to then just join the popular boat and go for it. But we'll leave it there. That's pretty much close to everyone. Now, you might be surprised to know that there are actually 6 different types of funds. And it is which I'll go through now on this slide here. So 16 types of fund. It's a little bit of a red herring of a question, because essentially there are two distinct types of funds which then can be broken down further. So most people will know you have unrestricted funds, which can be broken down into three different areas, which is your general unrestricted fund, which most people will be very familiar with. You then have a designated fund, a revaluation reserve, and then on the restricted side, you have something called an income restricted fund, which is essentially just a normal restricted fund. And then we have something called endowment funds, which we have an expendable endowment fund and a permanent endowment fund. Now, in this training session, I'm really not going to spend much time on endowment funds. I'm expecting that there will be some organizations in the training who have endowment funds, and very often they're churches that have been running for an amount of time and have been donated them. So I'm not going to go into too much detail on them, but what I will do is on screen here, I just want to give you some real helpful ways of remembering what these different fund types are all about, because there are a few that often get mixed up and can often people get confused as to which one's which and what they're for. So easiest one to remember is unrestricted general, which the key word I would give you is anything, and that comes with little limit. It's anything, can be spent on anything within the charity's objectives. A designated fund is earmarked by trustees or management. That's where the trustees or management have a choice that they're going to ring fence or earmark a set of funding to be spent on a set purpose, but it's in the full control of the charity as to where that is spent, and that designation can be removed, added, changed at any time. An unrestricted revaluation reserve, which is a bit unique, basically mirrors the asset which has been revalued. It's all to do with assets, and you can actually have an unrestricted asset reserve which mirrors an asset, but more often than not you'll see them because of you've got an asset, usually a building, that's been revalued. The other most common one is a restricted fund, which is all to do with legally restricted by the donor. And that's often the key one to remember, is people often get the confused between designated and restricted. And the key difference is that a restricted income source, a restricted fund, is all to do with a legal restriction by the donor. The government and the Charities Commission make it really clear that when a fund, a donation, a grant, or a contract is given for a very specific purpose to be spent in a specific way, it carries a legal restriction on it. And the last one is an endowment fund, which I won't go into any more detail on, which is basically an investment that's specifically held to generate income for a charity. If anyone does need any more information about endowment funds, please do feel free to stick a question on the Zoom chat or in the ExpensePlus forum on Facebook. I'd be very happy to follow up any questions on that. I've got a slide here which looks, if I'm honest, totally ugly, because it's just a load of text. And the reason why I've put this here is because these slides will be available afterwards. So these are the more detailed definitions of the different funding pots and some examples of what they are. I'm just going to quickly go through examples. Everyone knows what an unrestricted general would generally be spent on, which is anything to do with your charitable objectives. A designated fund would classically be something like a new development fund for a building or a very specific future cause that a charity might want to explore or want to develop something in a new geographical area. I've mentioned what a revaluation reserve, and then restricted income could be anything. It could be donated for any specific purpose that donor is given. So that's just a few examples, but this slide is just there for future reference when we send them out. So I'm just going to jump onto another area that people often get confused about, which is all to do with fund transfers. And fund transfers just make fund accounting that bit more complex on top, because fund transfers are distinctly different to income and expenditure. And there are some important rules to know about them. Essentially, a fund transfer, which is really very helpful remembering it, is you're moving a balance between the pots of funding that you have. It's completely separate to income and expenditure. And there are some very important rules to know about them, because there are times when you can make a fund transfer, and there are times when you certainly cannot make a fund transfer. So I'm just going to bring up our third interactive question just to help explore this a little bit further. So if everyone's ready on their phones. Question is, Which of these fund transfers is most likely to be problematic? So have a go and see what you think. Definitely got an early leader. Pink is miles ahead. I think we've only got a few more in, but yeah, that's great. I think most people got their votes in. Yeah, most people were absolutely right there. The most problematic fund transfer that's likely to cause a problem is restricted to unrestricted. And the reason for that, I'll just go through the different scenarios, is a very common transfer. You would have a transfer from unrestricted to designated, which is usually by the charity deciding they're going to set aside some funds for something specific. You can have designated to designated, where you decide that one designated pot might be finished, or it needs to change what it's doing. So you can have a fund transfer from designated to designated. Unrestricted to restricted, you can have the most common situation where that would happen is if you've got a restricted fund which has become negative, i.e. there's more expenditure than there is income, and you might want to transfer some more funds from unrestricted to top up that restricted fund so that it's not overdrawn. There are other ways to deal with that, but that is a legitimate way of dealing with it. But moving funds, fund transfer from restricted to unrestricted is usually problematic and usually a no-go area. The reason being is that fund that's restricted has to be spent on the restriction set out by the donor or the grant giver. So to move it out from that restricted pot into an unrestricted, generally spent on anything that the charity would see fit, is usually a no-go. Having said that, there are specific situations where you can do that. And the Charity Commission set guidance as to how that happens, because there are times when a restricted fund becomes either obsolete, unable to spend it, or it's just not needed anymore. And there are some very set criteria that you'd have to follow from the Charities Commission as to how to do that. So if you end up in that situation, then please do have a look at the Charity Commission, speak to your independent examiner, or feel free to stick it on the Facebook, the ExpensePlus Facebook group, and I'd be happy to chip in some information on that. But I think the other thing that's really important to know is when to use a fund transfer. And this is important because you might actually be able to get to your expected destination, or when you're looking at your fund balances at the year end, you know that you've got a fund that needs to be fully spent. You have multiple options as to how to achieve that. And one of the most common ways you're able to do that is actually by reallocating income and expenditure between different pots of funding, instead of just transferring a balance. So for example, if you've got a fund where you have you had some allocation for charity overheads, you're able to move some of that overhead expenditure from your general pot to your restricted pot instead of just doing a fund transfer. So hopefully that gives you a little bit of differentiation of how you might actually be able to manage your funds without just doing a transfer of a balance. So common pitfalls to avoid. Classic one is selecting the wrong fund type. As an examiner, that is something we're always looking for, the risk is choosing a fund type which isn't restricted. That's usually the common issue, is that you've selected a fund type which is often designated or unrestricted when it should be restricted. Transferring out of restricted fund when you can't, which I've already talked about, and transferring when it would be better to reallocate expenditure or income, because that just gives sometimes gives a much better understanding to the reader of accounts when they're looking at the accounts and seeing how expenditure is split. Not having separate funds set up on accounting software to track restricted pots, that's often something that can cause a problem. ExpensePlus is fantastic for tracking your restricted and other funds. We do work with lots of other charities that don't use ExpensePlus, and they have many multiple layers of fantastically interesting spreadsheets, which can cause some problems, but having your separate funding pots is really helpful. Not realizing that you have a negative fund balance. This is something that can just creep upon you. If you're not monitoring your fund balances on a regular basis, you can find that you have a negative one. Now, having a negative fund balance isn't necessarily a major issue, but it can cause some problems in needing additional disclosure in your year-end accounts. And then not prioritizing spending restricted funds. It can be that sometimes charities gravitate for spending everything out of their restricted fund because it's just easier to do that as a mechanism. And you can sometimes find that you've got restricted funding pots left over and you might end up struggling to spend them. So here are some of my top tips for navigating fund accounting. I'd strongly encourage you to use all the tools ExpensePlus has possible. One of the things that we find ourselves recommending as part of our examinations is we find that a lot of organizations aren't using the category connectors function in ExpensePlus. And it's a fantastic function that basically helps connect lots of different categories from all the different funds so that you can view all, basically have a really nice overview report of exactly what income and expenditure you have in one nice report, and it helps you manage your funding pots a bit better. And the fund summary report, if you were to pin me down and ask me what my favorite ExpensePlus report was, it'd probably be the fund summary report because you can see very clearly what's coming in, out, transfers, and your closing balances. Another top tip is when setting up a fund, double check you're happy with the fund type. It's always worth double checking. And if you've got a question as to whether you think something should be unrestricted or not, feel free to ask. I think there's no harm in asking. I often say to my some of my clients, I'd much rather people got in touch with me mid-year and asked me if they've got a question, because it might save some time and problems later on at the year end when we're doing the account. So feel free to ask your examiner or on the Facebook community group. Review your fund balances regularly. I'm a massive fan of this because I think if for organizations that don't often review your fund balances regularly, you can end up with those problems of negative fund balances and other things. And think if there's a better way to reallocate costs instead of making fund transfers, because it just helps keep things really neat and tidy, and you can see very clearly where your income and expenditure is sitting, instead of then having to follow your income expenditure and then see where you've done a bulk transfer. Common questions that often get asked about fund accounting is, can I have a negative fund balance? I know this has already come out, and the answer is yes, you can, but it does cause a problem, particularly if it's a restricted fund balance that's negative. Basically, in the year-end accounts, if you're doing if you're following accruals accounting, you would have to basically state why there's a negative fund that you are the charity is willing to basically underpin that negative fund and cover the cost through unrestricted. But the most easy way to deal with it is just to transfer from unrestricted to restricted to kind of cover off that negative balance. Second one is, if I have multiple grants for the same purpose, can this go on ExpensePlus in the same fund? And my answer to that is yes, it can. The only thing that to be aware of if you do have multiple grants or income sources for the same purpose is, for the year-end accounts, it's important for whoever's preparing the accounts or the examiner to know which funding grants have gone into to that fund, because they will often have to be disclosed in the accounts. So it's just making sure that you're aware that if you do that, you've just got a note, or it's really clear as to what those funding sources are in that specific funding pot. Third one, is I have multiple grants for the same purpose. Can this go on ExpensePlus in the same? I've multiplied that, haven't I? Apologies. Duplication there. I've not spotted that. That was a different question, but I can't remember what it was, so we'll just dodge it. Why is my fund transfer not appearing as income or expenditure in my report, and it's not appearing in my budget? Which is a question that came up very recently on the Facebook group. And the very simple reason why is a fund transfer is not income or expenditure, which I'd already mentioned. It's a transfer of a balance. And the helpful way I remember this is to just go on ExpensePlus, is if you go on the balance sheet. This is just the demo version of ExpensePlus. You'll see at the bottom, you've got your fund balances on the balance sheet, which also appear on your statement of financial position. Is essentially what you're doing when you're doing a fund transfer is you're essentially just transferring a balance between these different balance sheet areas. So it's completely different to income and expenditure. So that's a helpful way that I remember about fund transfers. So that's fund accounting. So we're going to move on to getting to grips with accruals and cash accounting. And what I've got on screen here is just a helpful table which just outlines all the differences between cash and accruals accounting, and I'm just going to talk through them just so that it's really clear, because we do regularly come across clients and organizations who speak to us that actually aren't necessarily clear about which one they should be doing or which options they have. So the principle for cash accounting is that transactions are accounted for when they are paid, when they leave the bank balance or your petty cash. Whereas in accruals accounting, transactions are matched to the period which they relate to, not necessarily when they are paid. Income is recognized in cash accounting when it's for receipts, obviously when it's paid, whereas income in accruals accounting is recognized following a really specific criteria. And I'm just going to take a moment just to follow this through, because this is something we spend quite a bit of time educating clients and people who speak to us on, is income in charities in accruals accounting is recognized when the income is probable, entitled, and it's measurable. And that is actually quite a grey recognition criteria, and people are often aware of that, that this is what the charities SORP outlines for accruals accounting, and that's really important, particularly if you're an organisation that receives grants and often receives large donations, because it might mean that you are notified of a grant or a donation or any other income source before it's received. And if that happens around your year end and you are probable that it's going to come in and you know the amount and it's definitely entitled to come in, you should actually be recognizing that income in the year that it's notified, as opposed to when it's paid. And that's quite a difference compared to how people naturally feel about recognizing income. So that's just something I want to highlight, and something maybe for you to think about if those different areas of income are relevant to you. Expenditure, receipts and payments, it's just all about when it goes out of the bank, and expenditure in accruals is recognized in the period which it relates to. So even if you receive an invoice after the year end and it's paid after the year, but it actually relates to work that was done during your financial year, it would mean you'd have to recognize it as an expense. Now, assets and liabilities in cash accounting, it's really straightforward. You just have to list them. There's no formal balance sheet, and often accountants will just use an insurance document to outline what your estimated value of your assets are. Whereas obviously in accruals accounting, you have a full balance sheet or statement of financial position. And the big last area, which I'm just going to spend a moment just outlining, which is I think is one of the main differences between accruals accounting and cash accounting that a lot of people we think are not always aware of, is there's a huge amount more of disclosure in the accounts which is required. In cash accounting, there's minimal disclosures, a few extra disclosures that are needed, which I'm going to show you on the screen in a moment. Whereas disclosure in accruals accounting, you have to follow the charity SORP FRS 102 disclosure rules, which are actually quite extensive. And we often find that when people come to us to do the examination, we find that there are often lots of disclosures missing. Often because some accountants do charity work on the side of their main practice, and they're not often aware. And we also find that some practices just don't include them, just because either they're not aware or there's sometimes some tension points with including certain disclosures. And one of the tricky areas with this is actually there's no because of how the Charity Commission work, there's actually no there's no consequences basically of not including these disclosures, despite them saying you must include them. So I'll just bring up on screen two examples of cash accounting and a full set of accruals accounts. So this is oh, have I not got it up? No, here we are. This is an example of some cash accounting year-end accounts. I've sadly, if anyone is actually from the Friends of Music of Leeds Minster, I apologise. I just picked this out completely random from the Charity Commission website. But as you can see, there is you have your receipts, which is what's come into the bank. You have your payments. And the year end, you have your surplus and deficit, which basically equals your bank balance. And that's the key thing. It's a very straightforward set of accounts which equals the bank balance. And they do actually have a formal balance sheet in this set of accounts, but essentially all it is the bank. I've sadly not got up my example for the accruals counting, but that's fine. What I will show you though is this is just a checklist that we use for all the making sure every set of accruals accounts has the disclosures that are required. And as you can see, it's quite long, and there are some that are fairly we often find that are not included in accounts. I'm just going to highlight one to you if I can find it, which is no, I can't. But anyway, you can see that there are a lot to consider. And it's something that I always highlight to people, that actually having an idea of what disclosures you need in your end accounts is quite important. And one of the key ones that we find are not always included are is disclosures around trustee expenses and trustee remuneration. And I want to highlight this particularly because I'm aware there's lots of churches that use ExpensePlus, and there's often a tension with how churches run themselves from a governance point, as there's often a paid employee who's also a trustee, and which doesn't always happen in charities which are not faith-based. And basically what happens is there's a requirement from the Charities Commission through the SORP that if you have a trustee who is employed by the charity, their salary and their employment remuneration should be disclosed in the accounts. And it's one of the key areas that we often find that isn't included, and it is a bit of a tension area, and it's a sensitive area for disclosing remuneration. So it's something that we're really keen to highlight to particularly churches and charities, that is something that Charities Commission do require, and just to highlight that because it is a sensitive area. So let's just move on to the interactive question 4, is when do you think a charity have to prepare their accounts on an accruals accounting basis? I'll just move the slide on. So multiple choice out of 4, just to see what you think as to when a charity has to prepare accruals accounts. Great, votes are flying in. I think we've probably got most people there. We're not far off, but yeah, strong contender is 250k, which is absolutely right. A charity has to prepare accruals-based accounting following the charity SORP when your income is around 250k. Now, some of you might be wondering, hang on a minute, my organization's income is under that. Why am I preparing accruals-based accounts? And what's really important is actually there are a number of reasons why you might be preparing accruals-based accounts, even though your income is not at 250k or is below. You might have previously had income in your organization of over 250k. You might have dipped below. And one of the things that often people aren't aware of is when you are around this sort of threshold, is when you are dipping in and out, one of the challenges you have is you have to, whatever you do in the current year, whether you're going to do a cash accounting or accruals counting, you have to update your previous year's set of accounts to follow the same basis of preparation. And that's why we often find that if an organization is in and around this mark and dipping in and out, we often recommend sticking to accruals accounting, because it's quite a bit of work to then adjust accounts back and forth between accruals and cash. You might, as an organization, have significant assets and liabilities that you want to fully account for and report for, so accruals accounting makes the most sense to you. You might also, as an organization, have some strange timings of transactions and types of transactions, which make accruals accounting far more practical for you in matching your transactions to the period they relate, compared to just doing it based on when they get paid. And the other really important thing to note is if your charity is also a limited company, you don't have a choice. You have to do accruals-based accounting. And there are still quite a few charities which are also limited companies and have to report their accounts to the company's house. So you guys don't, sadly, get a choice. Very quickly, I just want to highlight what is a balance sheet, what is a financial statement, because this is often for those who are coming into coming into running their charities' finances with little experience. This is often the statement that's really confusing. What is it? Because it really is quite an accountant's sort of information. And really quickly, it's basically a snapshot in time of your organization's financial position, which is all the items which have a monetary value, which one day will at some point turn into cash. So it's things like money that's due in, money that's due out of the organization, and fixed assets which you've invested your cash into. So that essentially is the balance sheet. So I just wanted to make sure I covered that off before we delved into the fixed asset one, just in case there were individuals on the training that actually that's been a confusing point for. So I just want to delve into understanding debtors and creditors. And there's a few important things I just want to highlight, particularly for those who use accruals-based accounting. In ExpensePlus, you'll recognize this fantastic blue screen, which you'll probably use towards your year end, which is where you will update your accounts for accounts receivables, your debtors, your creditors. And the thing I wanted to highlight on here is that ExpensePlus has two categories for each: accounts receivables, prepayments, and then in creditors, accounts payable and deferred income. And the thing I just wanted to highlight to you is that the charity SORP actually require you to break down your debtors and creditors in more detail than you do on ExpensePlus. And it's something that we often talk to our clients about, and it's something just helpful to note. This is just an extract from the charity's SORP, which is the kind of rule book, if you like, of what has to go in your year-end accounts. Is you would have to break down your debtors by a little bit more detail between trade debtors, prepayments, accrued income, and other debtors. And the main one that has to be split down even further is your year-end creditors, between accruals, trade creditors, payments received on account, deferred income, and PAYE, taxes, and social security. So you have to break it down further. So that's just a top tip for you there, is if you are doing a year-end accounts, or you're doing monthly adjustments, it's sometimes helpful to have a notice to what they are and what category they might come under. One of the regular questions we get asked is understanding what the difference is between different debtor types and creditor types. So I just want to give you a principle which I find really helpful for remembering all the differences are, using the idea of push and pull. So a prepayment is where you would push out expenditure into the next year because you've incurred something that doesn't relate to your year. And a classic example of that would be rent paid up front. If you've got rent paid up front for the next financial year, you need to push some of that out. Accrued income is pulling income into your year. Usually for lots of charities, that will mean gift aid that's been paid after the year. You would pull that gift aid claim that you've made to HMRC into the year, even though it's paid after the year end. Trade debtors, accounts receivable, is pulling income into the year, usually based on the invoice date or sales invoice and the work that's been done, or the service that's been carried out. Creditors, very much the opposite of debtors with the pull and the push, but accruals is pulling expenditure into the year that relates to the period, regardless of the invoice date. So you could get an invoice that's dated after the year end, but if you had work that you were related to work or a service that was carried out during the year, it needs to get pulled in. A classic example of that is accountancy invoices, where accounts preparation or independent examiner, where that invoice date will be well after your year end, but it relates to work done for that financial period. Deferred income is a really interesting one. The principle of it is you're pushing out income into the next year, but it comes with a health warning if you ever think you need to defer income. So if you ever think you might need to make this adjustment at the year end, just remember what was said in this training. And the reason why it comes with a warning is because of the income recognition criteria outlined by the charity SORP. If you remember, I mentioned that it's based on probable, entitlement, and measurable. And because of that probability criteria, it means that it's often rare that a charity would defer income. So there are certain times where you absolutely would, but actually it's not too common to do. And the reason, and it's reflected that it's not too common because the SORP actually require you to do some more disclosure when you do have deferred income. So that's just a little warning if you ever think you do, is just to ask some questions about that. And then obviously trade creditors, accounts payable, is pulling expenditure into the year based on invoice date. So that's just push and pull. But accruals accounting is just is a lot more than the numbers, as I've mentioned, to do with those disclosures which are required. I'm just going to give you some examples of the disclosures which are required, which is often worth checking in your year-end accounts if you do accruals-based accounting, and it's something that you might want to check in your accounts just to make sure that you've got and you're all sorted with. Trustee disclosures, which I've already mentioned, related party disclosures. key management personnel, events after the reporting period, and there's also some specific rules about government grants and additional disclosures you need to include. And I specifically mention that because obviously a lot of charities and organisations at the moment are receiving government grants through the job retention scheme and other grants. So that's something just to highlight, that if you think there are disclosures that are missing from your year-end accounts, they're just some flavours of what ideas of what actually you might need to have a think about and chat through with your account examiner. So common question at the year end is, how do I decide what to adjust at the year end? This is a really common question about what needs to be adjusted and what needs to be accrued for. How do I gauge what adjustments to make? And I've got three kind of three thought of ideas for you on this. Is one, and we've actually recently created a resource which is a year-end checklist for from the perspective of somebody preparing the kind of year-end information on ExpensePlus, which will kind of help you do that. So we're going to send that through with your slides after this, after the training. The key concept as well is only making adjustments that are material. You might have heard your accountant or examiner or someone else use that phrase, but essentially materiality is only doing something when it's of significant value, and if you were to adjust for it, it would have an implication on the accounts. And we often find that clients like to make adjustments for £5 here, £10 there. The youth tuck shop bought some more lollies, and after year end and all that, the small adjustments don't need to be made. Basically, they're not going to make a difference. So that's a kind of a top tip there, is only make material adjustments which will significantly change the accounts. And the other thing I'd always highlight is if you're unsure, discuss with your accountant or your examiner. They would be able to give you some indication on how to navigate that. So top tips, know which method of accounting you're using and stick to it, and stick to its principles. And the reason why I say that is because ExpensePlus is geared to do both. It can do cash, it can do accruals, but it will, if you're not sure, it will gravitate you a bit more towards accruals, because you'll see all the year-end adjustments and the fixed asset module. And if you are doing cash accounting, you just don't need to do any of that. You just need to analyze your bank. Accruals, know what mid-year adjustments are helpful for your internal reporting. There are some accruals which actually might be really helpful for doing your management accounts or other internal reporting. A classic one is if you pay your national insurance and PAYE tax, and it goes out of the bank account after the period, it's really helpful to accrue that into your period, into the month that you're reporting. And again, only accrue for material items is a top tip. So that is the end of accruals and cash accounting. We'll zip into getting to grips with accounting for fixed assets correctly. Now, as I've mentioned, if your charity has decided to prepare accounts under cash accounting, you do not need to worry about fixed assets. It's a big thumbs up. So if that is you right now and you're sitting here thinking, I'm a cash accounting, that's me, you can just switch off for the next 5 minutes, because you don't have to worry about this unless you're really interested in it. But this is really for those who are preparing accounts on an accruals basis. Now, fixed assets, for whatever reason, as was shown in the poll right at the start, it can be a confusing area, and I think a lot of the time accountants have a lot to blame for that. So here is a definition of a fixed asset written by an accountant: things that are resources owned by an organization which have a future economic value that can be measured and expressed in pounds. And it's reason, if I'm honest, it's accountants coming up with accounting jargon which can make fixed assets, understand the balance sheet, just that more confusing. So I'm going to try and debunk this and just try and iron it out so that there's a real nice simple definition of what really is a fixed asset. So I'm going to cover these key questions. What is a fixed asset? What should we include as a fixed asset? What value should the fixed assets be held at? And when do we account for it? And they're the key questions I'm going to go for. So a really helpful way to understand what a fixed asset is it's usually purchased for long-term use, which is not likely to be converted into cash quickly, such as lands, building, or equipment. It's used for a purpose, which is usually the really helpful thing that I remember as a fixed asset. What should we include as a fixed asset? And this is the really difficult question, and one that usually gets asked most often. And it can be quite a grey area. And the main reason for that is because a fixed asset for one organization may not be right to be a fixed asset in another organization. And there are three general principles I can give you for helping you discern whether something needs to be held as an asset on the balance sheet or just left as expenditure. The first one is its value. Is the value of the item that you've purchased material? If it's material, as in what I mean by that, it's going to make a difference to your year-end accounts, it probably should be held as an asset. For example, if you were to buy a phone, for example, for a team member in the office that costs £100, that's probably not material to your organization and doesn't need to be held on the balance sheet. The then principle is it a replacement, an improvement, or a repair? If it's a repair, it shouldn't be an asset. It's just a cost that's on your cost in your expenditure, and it's not a balance sheet item. And that can often be a really grey area, because some organizations might spend a huge amount of money repairing something, whether it's a boiler, a roof, or something, and actually that it still may not be right for that to be held on the balance sheet. Whereas a replacement is a little bit harder. If you're replacing an item that's like for life, it actually might need to be included on the balance sheet. It might be that you need to remove an asset that's old, that's been removed of, and include a new one that's been replaced. The other general principle of understanding is types of asset as well. It's really important to get a feel for what kind of asset type it is to help you know whether you should be putting it on the balance sheet or not. So I've got another interactive question on our slides is, when does a charity have to prepare their accounts? Oh, I've not copied that right, actually. I'll just go straight to the question because I'm not copied that right. Here we are. This is the right question. Which of the following items should be held on the balance sheet as a fixed asset? You can pick as many as you think. You don't have to just pick one. So have a read through, see what you think. We've got significant upgrade and repair to a church boiler costing £15,000. We've got a new iPad for a staff member costing £300. We've got new IT and computer equipment costing £5,000, and we've got an extension to a building costing £100,000. And they're just the kind of scenarios I've put together. Votes are flying in. I'll just wait a few more minutes, a few more moments. Great. So we've got a real split there. We've got a significant upgrade or repair to the church boiler costing £15,000. We've got a new iPad for costing staff member, which is quite low, and then the quite high ones are these two. So it was, if I'm honest, this was a complete red herring of a question. And the reason why I did this is because I wanted to help everyone get thinking, because actually in differing situations for different organizations, given the situation, each of these could technically be an asset to be held on the balance sheet. And I really wanted just to make that point so that to help you realize that there's no rule book which tells you this is an asset, this isn't an asset. It is all down to the situation of the charity, the charity's fixed asset policy, and the given situation that's going on. And I'll just talk through, for example, so extension to a building costing £100,000, you know, absolutely that's going to be an asset. New IT and computer equipment costing £5,000. Now, £5,000 to an organisation which has got an income of around £300,000 would be material and would be would likely be held on the balance sheet. If you're an organisation that's a £2 million charity with income, that £5,000 addition might not be material. Actually, it might not be worth putting on the balance sheet. It might actually just be worth writing off as an expenditure. New iPad for staff member costing £300. You'd think that was just immaterial, but if that iPad was bought with 20 other iPads as part of a resource to kit out the entire staff member, you might be actually worth putting all 20 on the balance sheet as opposed to writing them off. So there's different situations there for different organizations. So I hope that point comes across. So key thing really that's important is knowing what your fixed asset policy is for your organization. And that will determine whether you capitalize something to the balance sheet or not. And if you don't have one, I'd strongly encourage you to create one. And if you're not sure how to create one of the best ways to find out good accounting policies for your organization is going on the Charity Commission website and benchmarking your organization with another organization to see what they're doing. Obviously, you can ask questions as well, but we would often recommend to an organization which has income between 100 to 500k that you probably expense or you capitalize something which has a value of over 500 to 1,000 pounds. That's the kind of reasonable accounting policy. So that's kind of a top tip there that's important to know, which will help guide you to what fixed assets should be on your balance sheet and what should just be left as expenditure. So what value should the fixed asset be held at? Most common that an asset will be held at is historic cost, its purchase price, and then it would then be depreciated over its expected life. Depreciation is just an accounting concept for spreading the cost of an item over its life. So, for example, if you bought a piece of equipment for £5,000 and you thought it was going to last for 5 years, you would then just spread the depreciation over 5 years, and that would go into your expenditure and go into your income expenditure reports. The other option, which is fairly unique to land and buildings and financial investment portfolios, is held at revaluation. And if you have that situation in your organization, you will know about it. And my top tip for you, if you have got an asset which is held at valuation, which isn't an investment portfolio, is I'd recommend that you have a policy for your charity of how often you revalue that asset. Usually between 2 or 3 years is probably reasonable, but if your building or land is in a certain location where actually the value of it just keeps going up because of house prices or various other things, it might be worth doing every year just as part of a routine for your year end, so that you've got that for the examiner and you've got that for the accounts. So they're the two different things of how they could be valued. A big question that people often ask on the ExpensePlus forum, which has been asked this week, is when do we account for our fixed assets? And really, there's two options as I see it. Is one, when it's purchased, and two, you do it at the end of the year. And the reason why this is often a hot topic question is because when you move a piece of equipment or an asset out of expenditure to the balance sheet, it no longer appears on your budget reports. And a lot of charities really like to know that they've purchased an item and it's still appearing against their budget, because often it's a planned spend whenever you're buying a piece of equipment or an asset. So the top tip for that is to leave it in your expenditure category until the year end, so that you can monitor it, you can see how your budgets are doing, and then right at the year end you end up transferring that to be an asset, so that you've not got that tension between monitoring your budgets and making sure it's on the balance sheet. Your other option, if that is a problem and you are an organization that really wants to have reporting regularly on your balance sheet, is you might just have to reduce down your budget mid-year when you've spent something on a fixed asset and you've moved it over to the asset category. So hopefully that makes sense and answers a key question on there. Another common question: should I depreciate my building each year? Now, this is a question that often comes up, and the answer to that is you can, but I'd often ask why. Often a building will have a useful life, but it's very often, particularly if it's a church building or a building that's been in place for many years, that depreciating it may just not be reasonable, because that building is going to last a long time. So spreading the cost of it over as a depreciation into your expenditure may just not be reasonable. So it's something to have a think about if you think you are depreciating your building. There are circumstances where it's appropriate, and there are circumstances where it's just not. Another niche question that comes up is, should I capitalize the building work that I'm doing right now? And the answer to that is yes and no. Like a lot of the fixed asset answers, this comes into specific rules about assets under construction, and really from a year-end accounts point of view, you would need to capitalize building work that you're doing right now, but you'd only have to do that at the year end to show the progression of the work that's going on with your building if you have one. Last question is, how do I best keep track of my assets? Now, my answer to this is a slightly changed. You'd be interested to know, and you might have seen on some of the ExpensePlus features coming that are in development, and Sam just notified me this morning that there is the asset module is being updated so that it will be more of a fixed asset register, so you can keep a very key track of your of each asset item's depreciation. In the meantime, if before that comes on and you need to keep a key track, it might actually be worth having a fixed asset register that's separate to ExpensePlus, so you can see how the value of each asset and the depreciation that it's on. But you probably only need to do that, if I'm honest, if your organization has lots of assets. For those organizations that just have a few, using the current module on ExpensePlus will actually probably serve you very, very well. So top tips: know your accounting policy, and if you don't have one, put one together that's reasonable. If you're not sure whether it's an asset or not and whether it should be capitalized, ask. That's another key theme that I've put in my training is, if you're not sure, do ask. But hopefully the principles I've mentioned will help you discern, give you the confidence to discern whether it should be an asset or not. And if your organization has lots of assets, using that fixed asset register, it's just a really good way of making sure you're keeping on top of what value your asset is, particularly of what depreciation you've charged in what year. So there's some top tips. So the last one, we're coming into land and we're getting close to finishing up the hour session, almost on the dot, is getting to grips with what you should do at the year end. And this is just a short slide, really, just to give some helpful pointers to organizations about what to do. I'm a strong fan in having a year end routine, and having a year end routine or checklist, one, I think helps make the process of preparing your year-end accounts and getting them ready for examined or checked through far less stressful. It's very possible that if you've been doing this for a few years, you already have your own, and you might already have one prepared by your examiner. And we prepare our own and send them to all our clients. But I do encourage it. And as I mentioned, we've created a resource, which I'll just preview actually on screen, which basically just helps go through all the different possible sections that could come up, and how to do that in ExpensePlus. And when we've finished it, which I've not quite finished it, hopefully by the end of this week, there'll be some links to video casts about how to use ExpensePlus to check some of these things. So a classic one for trade creditors is ExpensePlus already has some really helpful tool for finding accruals and trade creditors in the expense section. So I'll do a little video as how to find them as a quick tool instead of having to manually pour through everything. There's some Excel tips of how to do that. So I'm a big fan of having a year-end routine and checklist. I'm also a big advocate for arranging and communicating with your independent examiner at early doors. It might be that you're able to cover off a key topic or question that you have before you get to the year end, so that you've covered it off. It doesn't become an issue when you're preparing the accounts. So you can cover off any complex areas early. And it's always a really good idea to coordinate with your trustees or other team members who are preparing your trustees report. The reason why I always say that is if there's something that's going to hold up getting your examination completed and your accounts prepared, it's the trustees report being done a bit late or being the last bolt onto the account. So I'm a big fan of encouraging, as part of your year-end routine and checklist, to have it incorporated your trustees report. I think I'm finished a little bit. Yeah, we're pretty much bob on time, aren't we, Sam? So I think I will finish off the training session there. Just want to say massive thank you. If anyone does want to get in touch with me, this is my email. It's tim@wyattco.net. You can find me on LinkedIn as well. If anyone's got any further questions that they might want to specifically ask that I've not covered, or just want to get in touch with some advice or find out about some of the services we provide, please do. The other thing I'll just mention is I've got on AHA Slides an option here for providing some feedback. So you should see, if you go on your phone now, there's just an open text area just to give some feedback. This is, as you can imagine, training isn't necessarily my day job, but it's something I really enjoy doing. So please do feel free to give any feedback on the session, what's been helpful, what's not been helpful. And I know there's plans to do future sessions. So if there's anything you think, oh, I would really love some training on this from the ExpensePlus team, or somebody else, then it'd be really interesting to hear what you have to think. So that should be there now. When you hit submit, you can submit multiple. We can just download that in a nice report. So I'll leave that there, and I'll stop screen sharing to bring Sam in for the Q&A time.
Thank you, Tim. That was absolutely brilliant, and I hope that wherever you're watching from, that you found that useful too. So we're going to move now into the Q&A session. So thank you for all the people that have sent in questions whilst Tim's been talking. We're going to go through them now. If you need to leave the meeting at this point, then please feel free to do so. And thank you so much for joining us. We're just going to pause for about 20 seconds, and then we're going to kick straight into the Q&A session. Okay, Tim, so we've got about 12 questions for you to go through that have been sent in. So I'm going to go through them now. First, I'm going to go through ones that have been sent in around fund types for you. So the first is a fairly quick and easy one. If I've got a fund for reserves, for example, to cover 3 months worth of employment costs, what should the fund type be? And we'll just unmute Tim.
Legend. So thanks very much. So yeah, so just make sure I got that question. So you've got 3 months of running costs to cover for. It's a fund that's there to cover 3 months of running costs. It's a really great question. There's no right or wrong here. You can have that. You can leave that as unrestricted. There's no reason why you can't have that as unrestricted. But you'll find that a lot of charities decide to designate that as a fund, so that it's really clear in your year-end accounts that this pot of money is here for rainy day, which is really helpful for users of accounts, whether that's any members or people donated to charity or potential funders. They will recognize that and see that actually, yeah, we can see that you've got a reserve, but you are earmarking that section of funding for rainy day, making sure you've got the 3 months that the Charity Commission guide. So yeah, I hope that answers the question. If anyone else has asked that and it's not, then please let.
Yeah, that's really helpful. And the second question, which again is should be fairly easy to answer. So, for the restricted fund type, does this include donations for a specific purpose? So if I was to give your charity, say, money to buy food for some food boxes, is that the right fund type for me? Yeah,
it is. Now, what I didn't mention in the training, probably because I forgot, is what can be tricky with restricted funding is when you get something that's fairly generic. So generally, if someone is giving you a donation and it comes with a restriction, that should be classed as a restricted fund. The government and the Charities Commission make it really clear that if someone is giving you, if you make a donation, you want it to be restricted, basically, so that it has to be spent that way. What is tricky though is if that's a fairly loose or greyish area restriction, that can be sometimes tricky to navigate, and that's where you need a little bit of discernment to know whether is it loose enough to leave as unrestricted and it's just going to go with the generic charitable activities that you do. So a lot of people will often give a donation and it just naturally a donation to what that charity does already. So that's the difficult one to know. So if I think it's just trying a bit of discernment as to how restricted it is, and also the spirit in which the donation is given as well, I think is helpful. If you're getting a donation and someone's wanting it really to go to something, then it's worth restricting. Whereas if somebody's like that, it's more grey area, it's a harder one. So I hope that gives a little flavour of how to navigate that one.
Yeah, that's really helpful. And I've got a related question to that. So let's pretend that the donation is given in a restricted way. Yeah. But what if it's really small? And what if you have lots of people? So I give you a donation and I want £20 and I want you to spend it on books, and someone else gives you £5 and it has to go towards flowers. Particularly if it's in a kind of one-off way, so it's not something that you're maybe a food bank where you're sort of running it as a longer project. Yep. Do you have to create a restricted fund for each of those, or would you recommend, say, bunching them together into a restricted fund?
Yeah, it's restricted gifts. Yeah, really great question. So I'll just answer this starting from the end position. So in your year-end accounts, you only have to, particularly for accruals-based accounting, you only have to disclose line by line material funds. So if you are getting lots of one-off little bits that are restricted, there's no reason why you can't have them in one restricted pot. The challenge is because it's restricted, you if you were ever asked, you still need to have some confidence and evidence to say, oh yeah, this is, we did spend it on books. So you've still got to have some confidence that you've monitored and tracked that, but it is a bit overkill to have 20 pots of restricted funding in ExpensePlus for those specific bits and pieces. So it's another grey area with a bit of discernment, but it's not needed to go to the nth degree. Sure. If you can track it, if you're confident you can track it another way.
And that's probably, just to say, that's probably where the helpful projects feature comes in inside ExpensePlus, because it allows you to break up a fund, essentially create sub-funds within a fund. So you can then essentially do both, I guess. That's really helpful, Tim. Okay, the next one, I don't know how much you can answer here. It might be a fairly quick answer and a follow-up by the person that asked it. So Claire Ferguson, if we don't cover this in that much detail, it's a little bit niche, but I want to ask it anyway. So Claire's discovered that an endowment fund given by a parishioner back in the 70s isn't stated in her accounts. Currently, they get paid money from that kind of endowment fund upon expenditure, on expenditure happening, but there's no paper trail. Should that endowment fund somehow be brought into her kind of church accounts, or should the endowment fund be set up as a separate charity? And this is why it's probably quite a niche question.
Yeah, it's great. This is what I call a Billy Belter of a question. So yeah, basically the way you deal with this is if question one, is it material? So I'm assuming that if you're getting income from it, it's material, because most endowment funds are usually of some sort of size that's generating income so that it's coming in. If it's material, my answer would be yes. And it's definitely your charity's endowment fund. There are sometimes, if you are a church, some confusion as to whether it's held with the diocese or not. But I'm taking a punt that you're a C of E church there, so you might not be. The way to deal with that, and you'd have to deal with that with your examiner, is you'd have to do a prior period adjustment, where you would essentially have to bring in your endowment fund as a fund as if it was in the previous year, restating your opening fund balances and then bring it in. So you'd have a little bit of mess in the year that you're sorting it, but it is absolutely doable. And my recommendation would be is if it's material to your accounts, then go for it.
Great, that's brilliant. And the next question actually is a similar thing, where maybe a mistake or something's an omission from a prior year. So a question from Gus is that, and I've seen this happen quite a lot of times, where he's got a fund stated on his accounts, but with the wrong fund type. So for example, someone might have restricted something that shouldn't have been. How does he go about changing that? Yeah,
usually just being really transparent in your accounts. Usually if you'd normally deal with that either with a prior period adjustment, which the charity SOAP outlines exactly how to do a prior period adjustment, or and usually the key criteria for doing a prior adjustment is working out how material it is. So if it's quite a significant fund balance and you're needing to change the type, then a prior period adjustment is probably reasonable. If it's a smaller fund type and it's not too significant to your accounts, just doing a transfer from one to the other, from if it's restricted to designated or unrestricted, just doing a fund transfer. And then all fund transfers have to or the charity SOAP say they must have a description with a fund transfer. So you just very simply in your fund transfer description explain why you're making that transfer, and just be transparent that if there was a type that was incorrect, just to correct that. So that would be fine.
Great. And then the final question on kind of on this section, just to clarify, if someone has a negative end of year fund balance, which you did cover, but is expecting income in, and this might lead on to the next section around accruals and deferrals, is that okay? Yeah, it is absolutely okay. You can have a negative fund balance. The only thing you have to do is in your year-end accounts is have some more disclosure. You have to include in your trustees report to state that you've got a negative restricted fund, and say how that's going to be managed, basically. So your description would be it's negative at the year end, but we're expecting X, Y, and Z to come in after the year end, so that it's being managed. And if you're not expecting anything in, you'd basically have to state that it would be covered by unrestricted funds in the event that it doesn't sort itself out. So yeah. That's really helpful. So we're going to move on now to 4 questions that have come in relating to accruals, deferrals, and kind of that section of what you talked about today. And the first one, again, is a fairly straightforward question. So if a grant comes in that's a 3-year grant, but it's given as a lump sum in year 1, is it right that 2/3 of that grant should be deferred in that year one kind of set of accounts?
Yeah, this is the second Billy Belter question that we've got up here, and this is if I'm honest, this is a hot topic, and this comes back to the income recognition criteria that I mentioned during the accruals count bit, that probable, entitlement, and measurable. And it's sadly, my answer is not going to be as clear cut as you would like, and it all depends on the very specifics of that grant. So my view, and there's different views in the industry about this, is my view is if your grant provider is very clear that this is a year-on-year funding, my key question would be is that if it was awarded right at the front as an upfront lump sum, and you, for whatever reason, did a terrible job of providing the service, or you stopped doing it, are you at risk of that money being taken back? And if you are, I would be accounting for that as by deferred income, because you could argue that the entitlement has not passed until you provided the service sufficiently. Yeah. So that's the key criteria. Now, if that's not clear and you've been paid it all in one lump sum, you should then technically be recognizing all the income in year one and using your restricted fund to monitor how that is progressing and how much of that has been spent. And the problem is a lot of charities hate doing that because it makes them show a whopping surplus and then a whopping deficit in the following year. And the problem is there's just not enough people in the industry who appreciate and understand fund accounting to see that actually what's going on here, we've got this big up and big down, which is what makes accruals accounting really annoying in charities, because the whole idea of matching is it's meant to smooth everything out. But in charity accounting, it's complete reverse with this probable criteria that you end up with natural up and downs. And it's the reason why I'm passionately communicating about it in a weird way is because it's a friction point, and it's trying to help people understand that. So yeah, hopefully that helps. But if the specific person wants to reach out, then happy to chat further.
That's brilliant. The next question is, what if I accrue income or expenditure at year end that either then doesn't materialize or ends up being a different amount?
Yeah, it's a great question. So if you do an accrual based on the best estimation, usually you would reverse that. So if you accrued gift aid at 5k at the year end and then you reversed it, so you've got a negative £5,000 waiting for that £5,000 to come in, and it's less than, and it's 4,000. It's not, it's all about materiality again. So if it's immaterial, not a problem. It will just mean that there's a little weird difference in the year that you didn't, the year that it was paid. If it is material, then you'd need to do a prior year adjustment again. So you'd basically have to, say you're in 2021, you would have to restate that 2020 comparative year and your fund and your carried forward fund balance. So that's always the key thing. And it's very often that people get a bit unconfident about prior adjustments. It feels a bit a bit naughty, but they do happen, and it's just about being transparent about it. So yeah.
That's great. And the next question is not kind of trying to, you've already mentioned that kind of different charities will have different policies and different thresholds. So this isn't trying to fix you to an actual number, but I guess, just to kind of go over stating a material value, what would you suggest a minimum value for material value might look like, say, for 250k charity and a 500k charity, just as a ballpark, just as an average charity?
As an average.
What type of levels should people be looking at?
Going to be held to this. If I see a quote online somewhere, Tim Wyatt said this is material, I'm in trouble. But
we'll delete it from the video.
Yeah, it is a good question, and this gets asked to examiners, auditors all the time. Before I answer it, and I will give you like a generic rule, I'll just explain why it's so hard. Materiality is so subjective. It's all to do with the reader of accounts, and one type of transaction might be more material than the other. A disclosure of a related party that you don't include might be more material than a 10 grand incorrection. So that's why I always get a bit nervous. But let's say you're a 250k charity, and let's say you had an asset on the balance, you needed to capitalize something and it wasn't. And the key barometer to check whether something's material is if it would have changed the view of a user of accounts. So if someone's looking at your accounts, would it change their view? So you're looking, usually I would, for 250k, you could look at 10% or sorry, 1%. So you've got like, 2,500 as an asset benchmark of its, you've got an error. But usually anything within a grand of around that accruals accounting threshold is worth looking at as a kind of benchmark. It's not necessarily a materiality thing, but if you're at 250 and you're looking at adjustments of around a grand, then you're in the right ballpark, is my gut feeling. So hopefully that gives a steer.
It does, yeah. And just to sort of clarify on that, if you were saying, look, I'm buying this iPad and it's underneath that amount, is the same value, the material value for, say, asset purchases, as well as, for example, whether or not you were going to accrue for something? Is it the same value for all of those different areas or not?
It is different, because for example, let's look at this. If you were going to do a year-end accrual for gift aid, you're at £248,000. You're cash accounting all the way home to Christmas, because you're laughing because you're not having to do accruals accounting, and you need to accrue £5,000, or 10 grand, or whatever it is. And even if it's a small amount, that becomes material. So that's what's hard with materiality, is there are different times and different situations where something becomes material. So it is really hard. So it might be that a grand adjustment to an asset, capitalizing, it isn't material in your situation, but for an accrual for your staff costs, for your tax at the year end, might be, because it's not comparable with the previous year. There's so many reasons why it could or couldn't be. So it's really hard, and I know it frustrates people no end. So
yeah, it's a hard one. People just want an actual answer. So
they do, and
that's
it's
really
hard.
helpful you explaining how kind of that works. And I guess related to that, someone said, do you have a template accounting policy? I guess that it's wrapped up in that.
Yeah, absolutely. And I think the key thing, the question is this adjustment going to change the view of the user of accounts? That's the key question. Some of those, I know that's not necessarily helpful, but it gives you a good barometer. Gives you at least a barometer. So
that's really helpful. And I think we've got one final question. This one is on fixed assets, and I think it is a fairly common question as well. So you purchase some fixed assets with restricted income. So you've got some restricted income, and you want to purchase some fixed assets. How do they? Well, this is kind of two-edged. The question was actually, how do we record this expenditure essentially from our general fund budget, which I think is a why don't you answer that one first, and then there's a subsequent question as well.
So are you happy to hit me with that again, and I'll make sure I don't go on a spiel.
So you've got restricted income, so you've got a nice restricted fund, you've done all the right things, maybe you've saved up for a building, so you've got that money in. The question, or maybe not a building, maybe something smaller, but how do you get that to show in your budget? It's a slightly red herring question, because the budget I'm assuming means general fund.
Yeah, great. So basically, when you've purchased an asset on restricted funds, what should happen is your asset value should mirror your fund balance. And the way that goes into expenditure is by depreciating. And when you depreciate that asset, it goes as expenditure on the income and expenditure statement, and it will then, the value will go down. So that's when it would hit your income and expenditure statement. That's normally you wouldn't even, that depreciation wouldn't even go to your general fund. That asset should sit in as a restricted pot and just keep decreasing down as the depreciation goes. So I think that answers the question.
Yeah, I think that's a mixture of two questions, really, I guess, in my mind, because actually, when does it hit your general fund? Well, it's a fixed asset, so it's not going to hit as expenditure in year one. And so I think there's that element of it. There's the element of how do we get it to the general fund. And maybe the question would also be, if you bought a building, say, that wasn't going to depreciate, how do you avoid it all forever having a restricted building fund, essentially, even though once it's been spent?
That's a really good question, actually. How do you avoid it being, I think I'd ask the question of, what's the risk of it just sitting there as a restricted fund pot forever? Because usually you're building, the restriction would be loose, I guess, if that makes sense, because your building's there to be used for general purposes. But particularly if it's you're not depreciating it, it's holding its value. Actually, having a fund which mirrors the value of your fixed assets. It's actually really helpful, because if that was sitting in general, you can, if people don't appreciate how fund accounting works, is it can look like you've got a whopping great unrestricted fund that you're sitting on, really happy days. Whereas actually, if you show that separately as a restricted fund, which is mirroring your fixed asset balance, you're actually getting a really better, clear picture of what your actual unrestricted cash, cash-free reserve is, that's not tied up in a fixed asset. So that's my non-way of answering that question.
Yeah, I mean, and that's a common thing that I see as well, where you have things like buildings not in your general fund, partly because it's more helpful to maybe have the general fund with kind of more your day-to-day sort of cash and maybe some of your accruals in there. So I think what you're saying makes a lot of sense. Well, Tim, thank you so much. That brings us to the end of the Q&A. Thank you for everyone that's joined the session, and hopefully you found it helpful today. Tim, brilliant. Thank you for what you've shared. If anyone's got any questions, please do either contact Tim direct or contact us. Thank you so much for joining us this morning.